Hey team, this is Boom Traders. Today we're going to look at the weekly overview of week 17 from April 2022. I'm TinTinTrading and let's dive right into it. Now the session overview, we're going to look at our two models, which are the tactical trading environment model and the risk vest model. Then we're going to go over a bunch of charts and what's been happening last week, how we interpret the action, and from then on we're going to finish off with a summary. Now if we start off with the risk vest, basically, we're still on a firm negative signal, and the sell signal date has been since 22nd of November. We've actually seen deterioration in the general market, in the up-down volume, and in the stock participation. All components are currently negative, and the bear market has really been developing in some sort of a stealth mode since the highs of 2022. We're going to show you what we've seen and why we got bearish at that date. But just to address a general question that we've been getting in the room is about the different states of the risk vest model. So basically we can have either a sell signal or a buy signal, and then we have these two intermediary alerts. So if we're on a sell signal and we see things that are participating before
moving to
buy signal, we might issue
these intermediate buy alert.
We did issue one of those on the way up into the rally, but we quickly saw that reverted back to a sell signal. So basically these are the two states, buy and sell, and these intermediary states or early warning signs. Now the tactical trading environment, which is based on stocks only, is currently on red. Red means that breakouts are not working well and maximum caution is advised. We briefly went to yellow, but then breakouts did not hold and were not able to further on rally. It didn't see any supportive action, so we're moving back into red. And the rally seemed like very much like a bear market rally. Now, if we look at the general market, we want to assess where we're at in order to see how much exposure we can put in the stocks in the names that are setting up, and if the stocks are setting up as well. Now, we did cover this a few weeks ago, but basically we are seasonally, we are in this midterm presidential cycle, and this midterm has actually been seen being very weak for the stock market. It's been one of the worst actually in the cycle, and this is just another headwind. Basically,
we're stacking
different indicators, different seasonalities in order to assess whether we should be leaning more bullish or bearish. From then, if we look at the Fed, basically the Fed's been coming up with some clever ways to validate tightening of the interest rates. They've been pushing up for having this kind of a soft landing, and this is an interesting graph from Ned Davis. Basically, we're looking at the previous times when we did manage
to achieve
soft landing and what was the current state, the state of the key macroeconomic indicators prior to that. And we're seeing very much a big contrast to where we are currently. That's why we've titled this slide that the Fed has a lot of work to do. There could be a soft landing, but there's a big difference and there has to be a lot of work. And generally, the go-to instrument for to do so is actually tightening of the interest rates. Now, this is one of the big worrisome things that we want to point out to you, that the speed at which the rate hike is issued by the Fed is actually, the market is really sensitive to this. So this is one of the main things we want to consider. And if we look at the different lines here, they represent the different speeds at which the Fed has issued rate hikes. And the one that we're concentrating on is this orange line here. And we see this is the only time when the stock market has actually underperformed into a much longer term since its first red hike. So this is the fast tightening cycle, and it has high impact on the market. And the reasons why we're getting into trouble is that the language that's coming out of the Fed that the market does not like is that they're likely gonna accelerate the pace of rate hike tightening. So here are a few of the comments. Basically, we're seeing that the Fed is looking to reduce its balance sheet, and it will be doing so at rapid speed, which puts us right into the orange line scenario. And we're also seeing that the interest rate hikes could come at a more aggressive pace, basically than the typical 0.25% gain, and could happen actually as early as May. So this means that the Wall Street is anticipating 0.5 or 0.75 percentage points. So that could be worrisome in the short term for sure. Now in the longer term, we see that we need a number of Fed hikes before a secular bear market, so that we can assess that we are in a short-term cyclical bear market within a secular bull market. So we need a few times for the Fed to increase rate hikes before we get into these gray areas which indicate
bear markets. And
actually it's happened, as you see, multiple times, multiple basis points, which have also been concluding with good moves up within the general market. Now, if we look at the overall markets, we can start off with the NASDAQ Composite. So this is the sell signal that we issued somewhere around here in the 22nd of November, exactly on this day. And we've been getting this moving action. And what we want to concentrate is kind of all the action after the follow through day. So we've kind of zoomed out on the side, and these basically, the green indicate different buy sign signals that we're monitoring, and the red indicate different sell side signals. Now all the way up to this rally, we got up to number 8, even though that some of them were issued on down days with only 2 sell signals along the way. This kind of taking note of the numbering is helping us to determine how much exposure we ought to have in the market. And if you remember, back here in the room, we had over about 50% of the portfolio and different names. So we did start to get exposure into market. Now, since then, we've been getting these bunch of sell signals, and now we are on number 9 with another distribution day that happened on Friday, which indicates that the sell signals are outweighing the buy signals, so that means we ought to be with a very light exposure within the market. But also we saw something else. If you remember, one of the days in the room, we mentioned about having the 200-day up here, and actually wanting to see that the rally either continues to push up through it, or at least develop this right-hand side action underneath it, in order for us to anticipate that the market is doing well. Preferably, this would have been combined with more development into stocks and better breakouts with good supportive action. Now, unfortunately, we're seeing completely the opposite. The stocks are not breaking out, they're breaking down. We're seeing a bunch of pivot and base failures, and we're seeing that the general market is actually going down. And the big problem here is that the lows of the follow-through day, which are right around here, are actually currently in danger. We're very close to them, and if we break them, we might see a big push down, which could indicate more likely the actual final low of the market. Now, if we look at the Russell 2000, basically we're seeing that this is also heading down, indicated by the 2 key moving averages, and we're seeing that what throughout last year was a really good support, indicative support, now has turned out into a resistance. From then on, the 50, the IBD 50 ETF, basically this is the composite, an ETF of what are supposed to be the most innovative
best stocks
from IBD. So we can just monitor the ETF to see how they're performing, and we're seeing that basically we're hitting again the lows back here. Why are we looking at the 50? Well, basically the 50 is what are the more likely names that will traffic into our Discord, because we follow closely this canceling methodology and the Mark Minervini methodology. What we saw is that the push up actually that we saw, which seemed quite bullish in the general market, did not seem that big into the 50 index. Actually, this just looks like a feeble rally up, and now we're right back at the lows of those supposedly best 50 names. So that's a warning. The BOUT index, or the Breakout Index, is also interesting. We were looking at this last week because we saw this tightening action up to the right, and we were looking for it to kind of break out, which have been an interesting signal, but unfortunately this did not happen, and we're right back and broke down the 200-day moving average, which was a sell signal. The SPX 500, similar to the NASDAQ, is actually moving down, and the lows are likely to be tested here within next week. Now, apart from looking at the general markets, we also look at what's happening underneath the surface or beneath the surface. And one way to look at this is to look at the stocks which are 4% or more up against those which are 4% or more down. The 4% moves are generally a beginning of a strong momentum, and we can see what we have here. Basically, this is a very big underperformance and a beginning of what might become a selling momentum into many more stocks out of the universe that we're seeing. The second thing that we look at is all the stocks which have relative strength of over 89. Well, basically, this is one of the criteria for the stocks that we pick. We're looking at names which are above 90, and this is pretty much the names that we're likely gonna suggest within the room. We're also seeing the same thing here. We're seeing that those which are at negative 3% are much more than those which are on plus 3%, and all of this suggests that there's stocks are selling beneath the surface. For those of you who are interested in these stocks, we actually have a scanner within our Discord or a screener whereby you can see that those on a daily basis as they trigger. If we continue, we can see also the stocks out of the NASDAQ Composite which are above their 200-day moving average. Now this has been, and if you've been following us, you've seen that we've been speaking about this, and we've been actually very concerned about it. And one of the main reasons why we issued the sell signal on November 22nd was that we saw this divergence of the market going up while the stocks are confirmingly moving down into fashion. Now the deterioration of this line is something that's been happening for quite some time, and we've never seen, when we've looked at the historical moments, when the stock market has managed to survive this type of deterioration, and it certainly didn't manage to survive this time. Now what we're seeing is that as we rallied up here, 200-day, actually the stocks which were making up the NASDAQ Composite, which were above the 200-day, were only 25% of the whole NASDAQ Composite. So this was a very alarming sign, and now we're seeing that as we move down, we continue to push down. We're currently at 16.86% of all the stocks in the NASDAQ Composite are above their 200-day. This is definitely a warning sign. Now what we want to see, and there might be two scenarios. Scenario number one is that we might start getting a move up from here, and we want to see the NASDAQ line, which shows the stocks above their 200-day moving average, to move alongside with the general market. Preferably anywhere at 50 or close to 50 would be an encouraging sign. The other thing that we might see is that we might start getting lower lows and actually undercut this low, and we might see this line again start to move up. Now this is going to suggest that many of the stocks are performing better, and that this will be a really good indication of creating of a low. From then on, if we move to the advisors, basically the advisors is a metric that we use that is studying a survey of over 100 independent market newsletters and assess whether each author or each community what is their favor of the market. Are they bullish or are they bearish? And what we see is that from this big scope that has been studied, only about 32-3% are currently bullish. Most of the advisors are suggesting bearish outlook for the market, and this is something that is very telling about what the retail investors are likely to do. So people are pointing out another interesting thing, and if we look at this graph, they're pointing out that we're nearing kind of the bottoms of the previous times when we've been touching this 30 line, or the 30% bullish advisors line, has been coinciding with the market bottoms. And certainly there could be a case to say that we are nearing a bottom because we are seeing the bullish advisors being so low. Basically, the general theory here is that the advisors is a contrarian indicator or an opposite indicator, meaning that when we see a lot of bearishness indicated by the low bullish advisors, we can say that there's no more sellers in the market, and from then on we bottom and we're gonna push up into the new high grounds because there's no one else to sell to. But the first thing that we have is that people are saying that, as seen by this line, we are at the COVID levels of this indicator, and that we might have a bottoming process. However, what we are suggesting is that we need to take into better consideration the current environment. When the interest rate environment is favorable, as it was in both here and here, you need much less bearish sentiment to be on a buy signal. But when the interest rate environment is hostile, we need much more bearish sentiment, i.e. we need to get lower on this line before we say that we have hit the bottom. So our stance here is that we want to see more bearishness in order to indicate, because we anticipate that the general environment of the rates does have impact on where this indicator is going to bottom. This is the second view, the AAII bull. And again, if we look at this is a much longer outlook up to 1989. We see that we're in a place whereby last time we were close to in 2005, and we've been close to in the 1990s. And this is kind of what we want to see. This is a really good indication that we're getting so much bearishness in the market. And the reason is exactly what I just said earlier. A lot of bearishness means that we're not seeing any more people to sell to. Pretty much everyone is short, and from then on the market can stop going down and can start going up. People are going to start cashing up their short positions, or they're going to close off their hedges, and from then on this is going to start creating momentum up, and it's going to shift the whole crowd psychology. So this is what we want to see. This is what we want in order to assess that we're in a market bottom. Now, if those two indicators are looking at what we're seeing or what people are saying, we want to see also what people are doing. And the way we do that is that we look at this line here on the bottom. This is from MarketSmith, which is the put call trading volume. Basically, the options trading, the puts and calls, are easily measured, and when traders buy puts, they're bearish on the market, and when traders buy calls, they're bullish on the market. So what this line looks at is what is the ratio between the two. So what is the put volume divided by the call volume. So if we see that we're getting above this line of 1, we can indicate that we're getting many more put buyers than call buyers, meaning that many more people are actually bearish. So as I said, in the previous two examples, we saw what people were advising, but we also want to see this in sync with what people are doing. And basically above 1% is something whereby we can say, yeah, everyone is saying they're bearish and everyone is really bearish. And this is the place where we can indicate that the market is bottoming. From then on, we like reviewing the previous historical examples, and one of the things is that we might get, and one of the times we got a soft landing is within this 1998 situation, where we had again a cyclical bear market. Now what happened here is that after we undercut the followed through day lows, here, we actually got a really nice rally up, and the sentiment was very much similar. It was very thick sentiment the way it is now. So this might help us create, as long as we cut this under low, this might help us create this quick turnaround situation. And basically, as you can see here, this is a very easy dollar environment. Basically, a lot of breakouts are going to work, and they're going to work really well. So if we get this kind of situation, this is going to be very favorable for our system. Now, another thing that we might get to is a 1994 scenario, and James Bullard, the president of the Fed, actually said that he believes that this situation is very much like the 1994, whereby the Fed was raising rates in February and the easing didn't really see until July in 1995. Now if you look here, this is the 1994, this is the 1995, we have the weekly chart. Basically, after we got these moves down, there was a lot of worry, a wall of worry that needed to be overcome. And then as we got that easing in 95, we started getting again this really easy dollar environment, which is what we are anticipating and what we're preparing for. So if history repeats itself, we might get the 1998 scenario or the 1995 scenario, both of which indicate and showed easy dollar. But we're not in that case now. So we need to wait for this in order to get cash heavy. And this is the place where you want to wrap up exposure over 50%, and for the more experienced of you, even on margin. So that's kind of how we review the market. Again, to show you this, we are currently again in a bearish, volatile state as per our metrics and our indicators, and we kind of want to move here. We want to move either into bullish or super bullish, neutral inquired, in order to get the easy dollars. Here is the difficult penny environment. So just in a summary, we've been getting the risk vest in negative, the tactical trading environment is also on red, the breakouts are not working well, the market is under distribution, volatility is increasing, the pullback that we said that we want to test failed, and we are likely going to retest the lows. So what we're saying is that maximum caution is advised, and we even suggest that there's no reason pretty much to be invested at the moment. You can do 10 to 25% of your portfolio just to dip your toes if you're more experienced, and if things are working for you, then you can move up to 50%. But currently we're seeing that on the broader landscape that the system is not working that well. So we advise maximum caution for now. Hope this was useful and gives you a bit of edge over the other traders, and we'll see you in the Discord room.